Hello everyone! Those who regularly see our channel's pre-market videos might have noticed that lately I have been giving more importance to analyzing the participant-wise open interest volume analysis. Part of the reason is after April I started to do regular option trading. Before that I only did it occasionally as focused mainly on investing. Nowadays I still do investment, but in addition I pledged those shares to do option trading. And as I mentioned in my thumbnail, so far I have managed to maintain above 80% success rate. Hence, in this video, I'm going to discuss my option strategies that I'm currently using. While these strategies can be used in any global market, but it have been particularly working for me in the Indian market. So, without further delay, let's get started. First, in this video, part 1, my option buying strategy. Then part 2, in another video, I will explain my selling strategy. I mean, if we ask any option sellers, they often say that option selling is like running a casino and option buying is like being a customer who comes to the casino. Hence, most option sellers believe they always have the probability in their favor kind of. But that's not true. To be honest, I made more money from option buying rather than option selling, which I know it's very unusual. Let me explain how and why. The accurate way of explaining option selling is by comparing it to the selling insurance, and option buying is like buying insurance for that stock or index. That's the perfect analogy, perfect way to put. Generally and most of the time, insurance providers make money because the premium increases based on the risk associated with it. For example, if a house is built near a volcano, housing insurance premium for that house will be very high. Similarly, medical insurance premiums for older people are higher compared to younger people. In this way, most insurance providers make money. That is why LIC currently owns about 50 lakh crore rupees in the Indian stock market. In the same way, option derivatives were derived and the risk associated with the option is estimated based on implied volatility. And the implied volatility is calculated using the Black-Scholes model, which has two very important inputs. One, time frame, time to expiry, and the second one, option bid-ask price. Simply we can say option price. Let's say this option price and time decay are the advantage for the option sellers over buyers. Hence, if any option trader is a buyer, I personally think they need to neutralize this premium risk that favors the sellers. So first, let's discuss about the option price. Generally in India, there is no option price risk. I have already made a detailed video on this, but I will quickly explain it for everyone's benefit. I got this graph from Rochers.com. This shows the top 12 countries derivative to cash volume. India is first with the ratio of 422:1 and the next is Germany with only 36:1. So for every one Nifty index trade in the spot market, 422 times derivatives are traded. Please see the difference and how much options are speculated in India. Because there is so much volume and so many sellers, bid-ask price started to favor buyers rather than the sellers. So the option premium in India are very low. It's basically oversupply and less demand. For example, on 20th December 2024, I wanted to sell a Reliance 1150 rupees call option for January expiry for over 120 rupees, like 150 rupees, which I personally think is fair value because at that time the stock dropped from 1300 rupees per share to 1205 rupees per share, and in between we have the quarterly result risk and the possibility that FIIs might reduce their selling spree after December because their fiscal year will be completed. So 120 rupees for a 1150 rupees share price means as long as Reliance trades below 1270 rupees at the end of January expiry, I will make money. Still, it's a huge risk since in December alone, Reliance share price dropped from 1325 rupees per share to 1205 rupees per share. But I couldn't sell it because there are a lot of option sellers. So if I wanted to sell the Reliance, I could only sell it for 82 rupees premium for the January expiry. If I had sold it on 20th December means this last 4 trading days, it just a dead cat bounce moved the Reliance price closer to 1220 rupees per share, then that might cost my options to lose huge money. This is the exact reason why 9 out of 10 option retail traders in India don't make money. I see most famous option sellers always say Indian retail traders lose in options because they are buying, but that's not true. 95% of the time, Indian retail traders are net sellers, so both option buyers as well as sellers are losing money. Anyway, my point is that in India, the option bid-ask price doesn't favor option sellers, hence that part of the IV and option bid-ask price is already neutralized when the seller's volume increases in India. Then comes the second factor, time decay. If required, please pause and have a look. This is the typical time decay used in the Black-Scholes model. As we see here, the closer to the expiry, the time decay reduces massively. However, if you look at 1 month to expiry, the decay slope is much smaller. 2 months to expiry, the decay slope is even smaller. And 90 days to expiry, there is literally a negligible decay slope. So by buying long-term options, we can neutralize or reduce the seller's time decay advantage, which is good. So it doesn't give an advantage to the seller, and mainly remember, it doesn't give advantage to the buyer as well. So now the important question is, how can we increase the advantage for the buyers? The answer is by adding fundamentals to it. Let me explain with an example. Nearly 80% of our channel viewers are returning viewers. So I'm guessing most viewers already know this. I said on 8th December 2024 week ahead video that on 6th December, I sold a June next year 25,000 put option for 670 rupees per lot, which most viewers requested me to explain about it. Here we go. Regarding the reasons, at that time, December 1st week, I was expecting some level of nervousness closer to the US Fed interest rate decision. Second, December end is the fiscal year end for most FI investors, so I was expecting some level of profit booking in Indian stocks since those FII investment firms need to show their profit performance in their portfolio and annual report. Third, at that time, both FII and DII held the majority of their index future positions on the short side. Fourth, in that week ahead video, I explained this. If required, please pause and have a look. At that time, this is the Nifty's weekly increase in the whole year 2024. Before this November-December 3 consecutive week Nifty rally, if we ignore the election-induced June-July period rally, there were other 3 times Nifty increased 3 consecutive weeks, and in those other 3 times, for the following 4th week, 1 time it increased less than 1% and 2 times Nifty decreased significantly. So this convinced me that we might have some level of selling pressure in the following week. Hence, considering these 4 reasons, I entered that position. And at the same time, I want to neutralize seller's time decay advantage. So entered for next year June month expiry, not before. Then in the following week, Nifty actually increased further by 0.4% from 24,600 to 24,800. However, because it's a 6-month long expiry, as I said, I neutralized the time decay, and so my premium didn't fall much. If my memory serves correctly, per lot I had a maximum loss of 500 rupees, which was manageable for me. But the important thing here is having the exit strategy. I mean, not just for this, for any trading in the stock market, it's important to have the exit strategy. If anybody saw my December 2nd week ahead video, I mentioned this. After 3 weeks of Nifty rally, on the following 4th week, if Nifty increased above 1% means, in otherwise about 24,900 at that time means, then I will book the loss. If it happened means, then my view was not correct. Fortunately, that week it increased only 0.4%, so I didn't square off my position. Then on the following December 3rd week, Nifty dropped significantly because on that Wednesday evening there was a Fed interest rate decision. So I don't want to wait and take risk. So I squared off with 3,000 rupees per lot profit, and I did conveyed in one of my last week pre-market video. Then after that, on Thursday and Friday, Nifty dropped further, but I already squared off. This is one way how we can add the fundamentals into the index options, and the additional ways will be considering the PE ratio, earnings expectation, etc. For example, earlier we discussed the Reliance option selling and why we shouldn't do that. In line with that, last week I bought the Reliance call options for the January month expiry and I'm holding it now. Here, regarding the fundamental reasons, we need to understand what is pushing down the Reliance price. There are 3 main factors: poor Reliance retail performance, Elon Musk's Starlink threat to Jio, and poor Q2 earnings due to low gross loss refining margin. First, about Elon Musk's Starlink threat, I think Indian government might deal with that politically, like how they requested some confidential shipping data last week from Bay of Bengal. So I believe that threat has been neutralized and investors have regained some confidence about it. As for the poor Q2 quarterly results, that was due to low Singapore GRM, which was around $3 per barrel during the last Q2 quarter. However, for Q3 quarter, it increased to $4 to $5 per barrel in October and November month, and it is expected to be around $5 per barrel in December month as well. In addition, in middle of November, Indian government completely removed the windfall tax. All these factors are expected to increase the Reliance earnings in the upcoming quarter compared to the last September quarter. Considering all these points, I expected a bounce back to 1250 rupees per share last week, but it didn't happen. Still, the share price has increased to 1220 rupees from 1205 rupees last week. Now, my exit strategy for this position is to square off if the share price reaches 1250 rupees. If not, I will hold until the end of next weekend and then square off next Friday regardless of profit or loss. Since until Tuesday 31st December, I feel the share price may not bounce because of the year end. Anyway, that's my exit strategy. Here, please note this strategy is working for me and I'm okay to book the loss, and it's not suitable for most of the people and it's very risky. So please don't take trade based on this. For making the pre-market video, I spend 3 to 5 hours every day researching stocks and index fundamentals. I think that's the reason it's working for me. And in addition, I'm not comfortable with firefighting against all those mechanical algo, so I prefer to do it this way. So please find your niche that works for you. One thing for sure, I'll tell all the fundamental stories I see that in the pre-market videos every day. Everything I mentioned today has already been discussed in various pre-market videos. One more thing, in addition to strengthening my fundamentals on the Reliance position, in last Thursday's pre-market video, I explained a graph showing how petrol and diesel consumption was low in India between July and September and how it increased in October and November. This increased the petroleum product consumption indirectly indicates that it's good for oil stocks. However, remember this is just one piece of information. We need to consider the other related thread to that particular company. This is the economic macro data released in the RBI bulletin, but as traders, we have to connect it to the shares. Similarly, in my India's industrial production growth rate pre-market video, I mentioned that ITC's major product grew by over 11% in October, but before that, between April and September, it hadn't grown at all, which I think we did saw in the ITC's quarterly result. So, the industrial production growth rate government macro data released on December 12th for October month favors ITC, but at that time, there was a GST Council increase threat, which has now been neutralized. Now, we have to look for November's industrial production growth data, which is due on January 12th to confirm this. Regarding the current threat to ITC, I'm not sure about the option price and how it will be influenced by its demerger. I'm planning to wait until the demerger and industrial production data to complete. Again, a warning, option trading is very risky. I'm just explaining what I am doing. Every day on the membership community page, I'm adding my option open interest volume analysis. I also plan to add stock news and its impact on the market, Indian macro data and its impact on stocks, etc. So please consider joining. For sure, I don't want to recommend any stocks in that. Regarding my next part in option selling strategies, I will update shortly. So that's all in this video. Hope you all got some information. Please consider subscribing the channel and liking the video so it will help me beat the YouTube algorithm and also motivate me to do more. Please don't make any investment decision based on this, as I'm not a SEBI registered advisor. I'm doing this for me and viewers' educational purpose only. Thanks for watching.